If you've been in the crypto market for more than a minute, you've probably heard the term taxable event. It's the elephant in the room for every crypto investor, especially when dealing with Bitcoin. As the world's most popular cryptocurrency, its tax treatment sets the standard for everything else. Get it right, and you save yourself a massive headache. Get it wrong, and you could be facing penalties. In this video, we're going to break down the fundamental difference between capital gains and income when it comes to your Bitcoin transactions. Let's dive in. The key here is that you are realizing a gain or loss on an investment you held. There are two major categories here, and the tax rate is completely different for each. This is the first big rule you need to know: short-term versus long-term. A short-term capital gain is when you hold the Bitcoin for 1 year or less before selling, trading, or spending it. The profit you make is taxed at your regular ordinary income tax rate. This is the highest tax rate bracket most people fall into, so you really want to avoid this if you can. A long-term capital gain is when you hold the Bitcoin for more than 1 year before selling, trading, or spending it, and this is where the savings come in. Long-term gains are taxed at a separate, often much lower rate than ordinary income. In many jurisdictions, this can be zero for lower income brackets or 15 to 20% for others. This is why the common advice is to HODL, or hold on for dear life, past the 1 year mark. It's not just for market volatility, it's a smart tax strategy. Let's look at the three most common ways people earn Bitcoin as income. Mining rewards. If you are a miner, the Bitcoin you successfully mine and receive is considered income at its fair market value on the day you receive it. After that, if you hold the Bitcoin and the price goes up, then selling it later would create a capital gain. But the initial receipt is income. Payments for work. If you're a freelance writer, a developer, or a consultant, and a client pays you 1,000 worth of Bitcoin for a project, that 1,000 is treated exactly the same as if they paid you 1,000 in cash. It is ordinary income, and you pay income tax on it. Staking and lending rewards. When you participate in DeFi or yield generation, and you receive new Bitcoin or other crypto as a reward, that reward is also generally considered income. It's compensation for allowing your assets to be used in the network. Crucially, once you receive Bitcoin as income, its cost basis, which is the original value used to calculate a later gain or loss, is the fair market value it had on the day you received it. This prevents you from being taxed twice on the same value. Let's put this all together with two simple scenarios to cement the difference. Scenario 1, the capital gain example. Say you buy one Bitcoin for $20,000 on January 1st, 2024. This is your initial cost basis. On June 1st, 2024, that's less than a year later, you sell it for $30,000. Your profit is $10,000. Because you held it for less than a year, this $10,000 is a short-term capital gain. This gain is added to all your other income and taxed at your regular highest ordinary income tax rate. Ouch! Now imagine you wait until January 2nd, 2025, 1 year and 1 day later, and sell it for the same $30,000. Your profit is still $10,000. But because you held it for more than a year, this is a long-term capital gain. This $10,000 is taxed at the much lower long-term capital gains rate. That one extra day of waiting could save you thousands. Scenario 2, the income example. Let's say you are a graphic designer. You design a logo, and the client pays you zero point 0.1 Bitcoin. At the time of payment, that zero point 0.1 Bitcoin is worth $3,000. That $3,000 is immediately treated as ordinary income and taxed at your regular income tax rate. Your cost basis for that 0.1 BTC is now $3,000. Now, 2 years later, you sell that 0.1 Bitcoin when it's worth $5,000. The profit is $2,000, $5,000 minus the $3,000 cost basis. Because you held it for over a year, this $2,000 profit is a long-term capital gain, taxed at the lower rate. Most of your day-to-day trading will fall under capital gains making that 1-year holding period the most critical date to track. Anytime you earn Bitcoin, whether through mining, staking, or providing a service, you're dealing with income. The most important takeaway from this video is that you must track every single transaction. That means date of acquisition, cost basis, the dollar value of the Bitcoin when you got it, date of disposition, when you sold or spent it, proceeds, the dollar value you sold or spent it for. If you found this breakdown helpful, please smash that like button and subscribe for more deep dives into the world of crypto. Let me know in the comments. Are you aiming for long-term or short-term gains this year? Yeah. Thanks for watching, and I'll see you in the next one.